us a little bit about what your job is, what a 1031 exchange is, and things that you want, the audience to know about.
Well, the basics of a 1031 exchange are when an investor is selling investment property and planning to use the proceeds for more real estate investing, they can defer the capital gains tax they would normally owe on their sale, as long as they follow the IRS guidelines to make sure it all complies with the code. And within certain time frames, they can roll that tax obligation into their next property.
Joe, how much is like the capital gains or Barbara, how much is like the capital gains that somebody would be paying on, say, $100,000 in profit?
Okay, tax question is not easy, or not simple, I should say.
I know it was a loaded question.
The way you're taxed on the sale of an investment property is the first level of tax is your depreciation recapture.
Okay.
That's taxed at a flat 25% federally.
Okay, can you explain that in layman's terms, depreciation recapture? Because even I'm like, this is still something I want to learn a ton about.
Certainly.
A little green to it still.
Certainly.
So yeah.
Okay, so the depreciation recapture is calculated based on the depreciation that you've deducted on your tax return over the time that you've owned your property.
Mm-hmm.
So each year on your tax return, you're allowed to have a deduction against your rental income for a portion of the cost of your property.
Mm-hmm.
That's called depreciation. When you sell that property, the first level of tax you pay, if there's a gain, would be to recapture that depreciation. So IRS would say, okay, if you have a $100,000 gain,
Mm-hmm.
how much depreciation have you taken over the life? If it's $30,000, that first $30,000 of gain would be taxed. What they are trying to get at is ordinary income, but they've assigned a flat 25% to that.
Okay.
The next level of tax would be your capital gain tax, and right now it's favorable over ordinary tax. For most taxpayers, it's a 15% federal rate.
Oh, that's not bad.
That's not bad. For higher income taxpayers, very generally, income of $400,000 or more, very generally,
Yeah.
the capital gain rate is 20%, and that's federal. So then you would also be responsible for the state portion, depending on what state you're in.
So let's do a simple example, right?
Mm-hmm.
So say, let's take my property for example. What figures do you need to know about the property in order to give the audience maybe a breakdown that we could put on the screen here so they can kind of see in layman's terms like you're talking about? So I bought this property, it's a multifamily for $100,000 in 2016. I'm selling it for $530,000. So what in between else do you need to know, and how does it affect, what amount I have to use for a 1031 exchange, or is taxable, etc.?
First of all, we generally bring your CPA in for the conversation.
Yeah, they'll know the full picture of your.
Yeah, so, but we would need, or your CPA would need to take a look at what depreciation you've taken since 2016.
So say, just for conservative purposes, say $20,000.
Okay, so now your basis is calculated at your cost, your 100 minus the depreciation you've taken. So now you have basis in that property of 80,000. So if you sell for 530, you would have a gain of 450,000. Now, if you were to do a 1031 exchange and you were to reinvest equal to or more than the proceeds, equal to or more than your sale price as adjusted.
Got it.
So let's just use the 530.
Okay.
If you were to reinvest equal to or more than that 530, you would, all of your tax would be deferred.
Got it. So the sale price is really what is most important.
The sale price.
Yeah, that's our rule of thumb. You want to be reinvesting equal to or more than your sales price for a fully deferred exchange.